The next thing we're going to talk about is periodic instead of perpetual. Periodic is when you simply count the inventory at the end and whatever's not there has been sold. So for periodic inventory, if you notice that this is basically the same data as above. However, what I do is I get rid of the sales, and quite frankly, as far as the cost of goods sold entry, I'm still going to have, let me go back, don't have it on there, this one. I'm still going to have the accounts receivable, sales, all of these entries. I simply do not have these entries. I don't have the second entry. And the reason is I'm going to do the second entry at the end when I know how many is left, so I know I can compute how many are sold. So kind of what I do is I record the sales. So I'm going to record the 21,000, the 10,8, and the 7,200, but then I rewrite it like your handout does, and I get rid of the sales. So I have 1,000 at 20, 500 at 22, 600 at 23, right there. So I pretend all the sales happened at the end as far as these journal entries go. I'm going to get back to it. Okay. All right, so now I'm just going to get rid of this thing because I don't need it anymore. I just wanted to show you it's the same. So what happens now is I count inventory on hand. So if I had 2,100, and I got that 2,100 right there, available for sale. So in other words, we got beginning inventory plus purchases of 1,100. So I have 2,100 for sale. If I had 800, I'm not doing that very well, 800 that were left, I know that I can compute that difference, and 2,100 minus 800 is 1,300 sold. Okay, so I know that I have 1,300 sold. I know that this number right here is the 45,180. Okay, right there, 45,180. What I need to know is what is the value of the amount that is sold and the amount that is still here. Okay. All right. So the 800 is the amount that's still here. The 1,300 is the amount that's sold. So all I want is a number. And honestly, that number depends on whether you're using FIFO, LIFO, or average inventory. Okay. And so I'm going to delete that here so you can see more of it. Fill that in on your sheet there. So under FIFO, first in, first out. So remember, I computed that I sold 1,300. So right over here, what I'm going to do, this is cost of merchandise sold here. Cost of goods sold, cost of merchandise sold. And this is going to be my ending inventory. So I do know that I sold, working very good. I sold 1,300, so I want it to add up to 1,300. So first in, first out, I know that I sold, do it on this side there. Okay, so I know that I sold the first ones in, so the first ones that came in are the $20 ones, so I sold all 1,000 of those at $20. Okay, and then I sold 300 more, so I sold 300 at the next level down at the 2240. So I have my inventory. These are all gone, so I need to just draw a line through those for now. You don't do it because we're going to use it for the LIFO. Okay, and then over here, I'm going to say, okay, I sold 500. I sold 300 of the 500, so that's 200 left. So I have 200 at 2240. I would keep them in order. I don't like how they flipped them. I would put this on top. Okay, because under LIFO, that's going to kill you. So I have 200 left at the 2240. So that goes over here, 200 times 2240, and I have all 600 of these left at 2330. So this column is going to be this right here is what you're going to put there. Except you're going to flip it. You're going to put this one on top. So I have 200 at 2240. 600 at 23, so my ending inventory is 18,460. That is FIFO. So again, it's just exactly like perpetual, except that I take out my sales and pretend they're all the same at the end. You can also see under FIFO, your perpetual and periodic are going to be the same. Let's go to LIFO because it won't be the same. Okay, I guess I will go through this. So beginning inventory is 20,000 plus purchases of these two is 25,180. Gives us available for sale. And then what happens is I compute either ending inventory or cost of goods sold, and notice they both have to add up to this. So on all your ones, if you would like to go up, back up on all of these, if you add up this plus this for every single method, it's going to be 45,180. And so you can kind of see if you made an error. The idea is inventory is either sold or still here, so it's all going to equal 45,180. Okay, so let's go to LIFO. Okay, so I might have to type this in here. So I also under LIFO, I know that I sold 1,300. So I know it's going to add up to 1,300, except I'm going to go under last in, first out. And the last ones that came in are these 2330 ones, and there's 600 of those. So I sold 600 at 2330, and that's going to equal 13,980. Okay, I keep them in their same layers. You do not have to, but it just prevents mistakes. So I got rid of these, so these are wiped out. Not drawn very well. Clear that. These are gone. Okay, so now I have to move up, so I need 1,300. I'm not there yet, so this is a line right there. All right, so I'm going to move up to here. And I have 500. Well, 500 plus 600 isn't 1,300 yet, so I'm still good. So I have my 500 at 2240. And that equals 11,200. Okay, and again, so I've wiped out this layer, so I can cross that off. So I don't have anything over there for it either. And so then what I need to do is go up to my top layer, because I haven't wiped it out yet, and I need to add up to 1,300, so 500 and 600 is 1,100. So I need 200 of the top layer, so 200 at 20 bucks is going to equal 4,000. Okay, so now I can go over here and say, okay, I sold 200 of the 1,000, so my ending inventory is 800 at 20, so it equals 16,000. Okay, so my ending inventory for FIFO up here, if you added those all up, was 18,460, which was the 200 at 2240, and then the 600 at 2330. LIFO, I've still got 800 in ending inventory, but they're at 20 bucks for 16,000. So again, I can add these up, and that total 4,000 plus 11,200 plus 13,980 is 29,180. So that's my cost of goods sold. I double check it. 29,180 plus 16,000 should equal 45,180. Okay. And so you can see 45,000, 16,000, 29,180. Another way you can get it is just determine one of these. So if I knew, okay, last in, first out, so these are gone, the $20 ones are left. So 800 at 20 is what's left. So then I can take 45,180 minus the 16,000 and back into that one really quick. That's another way you can do it, but if I would suggest you don't do that until you completely understand it, so you don't make errors. So anyway, here's your cost of goods sold statement. Average costing is the last one. Average costing, again, is the same idea as the prior one, except it's going to be quicker because you only have to do one average. So all I do is total cost Total cost is 45,180 divided by total units of 2,100. So my average cost for every single unit is 2,151. And so for my cost of merchandise sold, that's on this one. I sold 1,300 at 2,151. And so that equals 27,963. And I have, on all these ones, I have 800 left in ending inventory at 21.51. So that equals 17,208. Okay. Now, this one you might get a little off due to rounding, because I think if you divide that by 2,100, 2,151 is little rounding. And if you add 27,963 and 17,208, you don't get quite 45,180. However you do it, round it, it's fine. I just generally round it to 2 decimal places. Some of you will say, okay, well, I only computed one of these and backed into the other one. So you might get 27,972, I think is if you determine 45,180 minus 17,208, you might get for 27,972 is just simply taking 45,180 minus 17,208 to back into that one. Or you could take 45,180 minus the 27,963 and back into that one and get a little different. But anyway, I'm not too worried about rounding issues. Okay, so there's 2151. They have 17,208. They back into the other one, 27,972. Again, I'm off a little bit due to rounding. Okay, so that is periodic inventory. This is a slide that talks about comparison of the two. So notice that gross profit, if I had operating expenses and net income, my operating expenses would be the same under all 3 methods. So you can just kind of compare them under gross profit. But my gross profit is always going to be the highest under FIFO, the lowest under LIFO, and weighted average is going to be in between. So therefore, since this is the lowest gross profit means lowest net income, which means my taxes are lower. So a lot of people use LIFO for tax purposes. And then you can use FIFO for income statement purposes, because remember, your income statement is supposed to reflect what actually happens, and FIFO sometimes more accurately reflects the flow of inventory, because you kind of try to clear out your inventory each year. Think of stores that put their old inventory on clearance to get it out, or cars that sell their old inventory to get it gone. So FIFO may more reflect your financial statement purposes. LIFO is allowed for taxes, so a lot of people use it for taxes. Okay. And you can read through these. Just make sure that you understand this. Notice here's a criticism of FIFO. When you have rapidly rising costs, then you're going to sometimes have somewhat illusionary profits, because I'm always selling my old inventory. And you may say that's actually realistic profits. So you could feel free to argue with the accounting standards. But you know, if you have your profits, some of it are just due to the fact you bought your inventory quite a bit ago. So think of very inflationary economies. Venezuela right now is experiencing high inflation. And so basically, if their companies have tons of profits, some of it has to do with they bought it when it was cheap. Okay. This talks about taxes. So make sure you read through these. I might expect you to be able to read them. Okay, so we're going to move on to a couple other things on this handout. Valuation of lower of cost or market. If you recall, we have inventory valuation. Inventory is an asset, and an asset is something of current or future benefit. So if I have some inventory that I cannot sell for what I bought it for, so think of those clearance items that I just said. So I want to get them off my shelf, so I may mark them below cost. If I have an item of inventory whose market is less than cost, the current or future benefit of that asset is not what I have it on my books for. And so what I have to do in order to not commit fraud is when I say I have something worth more than it is, I have to mark them down. Okay, so what does lower of cost or market mean? So sometimes in the idea of lower of cost or market, there are a couple of different uses of the word market. Sometimes market means what I can sell it for minus disposal costs, and sometimes market means replacement cost. Okay, so we're going to do the first one. So in this case, lower of cost or market is the net realizable value. So the net realizable value is the selling price minus direct cost of disposal. So for instance, if I wanted to get rid of some of last year's inventory, but I had to advertise to get people there to have them come here, that's a direct cost of disposal. So my net realizable value would be my estimated selling price minus the advertising. If I said to somebody, I'll ship it to you for free if you buy it, I would have my selling price less my shipping costs. So this is the net amount of cash I'm going to get from selling that thing. So that's what the market is in that case. So we're going to go through one. So right here, we're on this one. Okay, this is kind of a different one. So I have my estimated selling price. So here's my original cost. So right now it's on my books for what I paid for it, which is $1,000. Net these two. So you're going to net these two, and they equal $650. Okay, and so what I do is I want to take the lower of 1,000 or 650. 650 is lower, so I write them down on my books to 650. So I actually would credit inventory to get inventory down and debit loss on inventory. So I'm going to do it at 650. Okay. Next one. Also you can do it for, notice here I have inventory, unit cost, and market price. So here's my unit cost, 4,000 times 225 is 4,100. Here's my market, 400 times 950 is 3,800. And so if I do it individual by individual, I could say, okay, well, this one's lower, market's lower here, cost is lower there, market's lower there, and cost is lower there. So here I have a question. Do I have to do it individually by individual item, in which case my inventory would be at 15,170? Or can I just get all of the cost for all of my inventory and all of the market for all of my inventory, and now I've got lower of cost or market, and that one's lower. So do I value it at 15,472 overall or 15,070? There's also another one that I could have classes of inventory. So for instance, if I was selling cars and trucks and SUVs, etc., what if I combined all of my cars and got this total for cars and had another total for trucks and had another total for SUVs? Do I do it for those individual categories? And the answer is either. Either is okay. You can value your inventory at 15,472 or 15,070 as long as you're consistent. So make sure you know that. Okay. Oh, that's that one. Okay. Please go through these slides and your book, figure it out, or both. Okay. So what do you have to tell in your financial statements? Well, you have to tell what method you use in the notes to the financial statements, and you have to tell if you valued at lower cost or market, as well as FIFO, LIFO, weighted average. Okay, so errors. People make errors all the time. We talked about FOB destination, FOB shipping point. Items on the road, it's very easy to miss items on the road. Consigned inventory is when someone else sells your goods, so they're at another location. So sometimes those are easy to forget. And sometimes you just miscount it. If you've ever made an addition error or something, you can do that. Okay, that's the FOB. And just basically, I don't know that I've ever memorized this, but remember, inventory is either sold or still here. So if you have, your cost of goods sold is wrong, your inventory is also going to be wrong the other way. So if if cost of goods sold at the end of the year is too low, then cost of goods sold is going to be too high. We'll walk through some of those in class. Okay, so notice that if you miscounted in one year, ending inventory becomes beginning inventory in the next year. So beginning inventory is beginning inventory plus purchases equals available. So in essence, beginning inventory is a positive number. So 55 plus 650 is 750, and ending inventory is a negative number. So if it's ending inventory is off in one year, the next year you're going to add in that wrong number, and notice that over 2 years it fixes itself. So if you're an optimist, you could say at least it fixed itself next year. If you're a pessimist, you can say if you count inventory wrong, you mess up 2 years of financial statements instead of one. So it's just whether you're a glass is half full or a glass is half empty person on that one. Last couple of items, again, these are really good, is inventory turnover. Inventory turnover is pretty important. It's one of the more used ratios, especially in manufacturing. So what I want to know is on inventory turnover, the average number of times I sell and restock my inventory each year. The formula is cost of goods sold divided by average inventory. Average inventory is beginning of the year plus end of the year divided by 2. So what I just want you to do right now is circle these numbers and figure out the average and write it out to the side. Circle these two numbers, figure out the average, and write it to the side. Okay, so now that you've done that, I can see that I have 31,292 divided by that average, which is 5275. So I turn it over 5.9 times a year. 6 times a year, if I'm turning it over 6 times a year, that would be every 2 months. In year 1, I turned it over 5.1 times. So I want to turn it over more often, so I'm getting a little better. Another one is the number of days sales and inventory. You take average inventory divided by your average daily cost of goods sold. I'll show you another method to do this, possibly in class. But anyway, so cost of goods sold divided by 365 is this much sales a day. So I'm going to take 52, the average inventory, divided by average days sales. So I have 61.6 days of inventory. So inventory basically sits on the shelf 61 days before it's sold. In year 1, it sat on the shelf 71 days. So I'm getting better there too. Okay, so that's it.